Unless you're going to purchase a home all cash, you probably have to finance it. Mortgages. It's the real estate show. Welcome to the Real Estate Show. My name is Rick Naples. I am the owner-broker of Zone Realty LLC. You zone your home. Well, you've decided to buy a house. Maybe it's just the right time for you to make your move. Whether you're selling your present home or buying a home from the beginning, one of the most important things you're going to need to do, unless you're buying cash, is get a mortgage. And the mortgage process can be very easy or very challenging depending on what your specific situation is. Now, first of all, I want to begin this with a disclosure. I am not a mortgage officer. I do not underwrite mortgages. Zone Realty LLC is not a mortgage company. We are a real estate agency. However, as a realtor in the business a number of years, I do deal with a lot of different mortgage companies, and I've helped a few people here and there, you might say, purchase a home. So I've been able to understand how the mortgage process works and help advise as well as counsel, along with the mortgage officer, how the buyer needs to proceed in order to meet the requirements to get a mortgage. Now, there's a lot of mortgages out there. There's all kinds of different kinds of financing. There's financing that's available to get a mortgage for the first-time buyer that helps with things like down payments. There's financing that's available for our veterans. There's financing that's available for buying a foreclosed house. All different types of programs. And again, not being a mortgage officer, I'm not going to go through those specific types of programs. Those are something that you're going to have a conversation with when you meet with your mortgage officer. So let's start from the beginning. You decide to buy a home. You're going to go shopping for a home. You have to find out what you can spend to buy that home. You need to get pre-qualified or pre-approved for a mortgage. So you're going to contact the mortgage company of your choice, and you're going to talk to the mortgage people there, and they're going to ask you a series of questions to kind of get an idea of what your affordability level is. And those questions are simple questions like, how much money do you make a year? What is your total debt? When is your time period as to far as how you'd like to make this move, and so on and so forth. So there's very basics. But let's say you get through all of that and you've decided on what company you're going to work with, and you get your pre-qualification, and you've gone through, worked with a realtor, found a home, made an offer, had that offer accepted, and now you're in the process of obtaining the mortgage to put on that home. There's a number of different things that you're going to need. Now, I've talked many times over the years here on the Real Estate Show on what I call the shoebox technique. The shoebox technique is just basically having items ready, set, go for the mortgage officer when they're needed. Things, for instance, like your paycheck stubs, your tax returns, bank statements, things along those sorts. Because as you go through the mortgage process, the mortgage officer will gather this information with you and send it to the underwriting department. Now, the underwriters, their responsibility is to make sure that everything checks and balances. All the information that you've provided is investigated and is found to be true, and they have all the background on that information, and it matches the checklist of items that they need in order to package the loan together to get the funding to provide you the mortgage. Sounds complicated, and sometimes it is, because there's many different ways that your mortgage process can go. I guess the best way to describe it is sideways. There could be some challenges. Now, here on the Real Estate Show, sometimes over the years, I've spent some time in talking to you folks and kind of express things in the way of a story to explain what I basically mean. So I want to present my first story. The first thing I want to talk about is this is a case where a home has been found and the buyers are obtaining a mortgage and they're going through the mortgage process. One of the interesting things, or one of the requirements that the bank requires, the mortgage company requires, is your most recent bank statement. Now, when you send that bank statement in, you're sending it in to show, A, that you have monies on deposit, so you have the money in place for your down payment and potential closing costs, and who you have a banking relationship with. It's a way for the bank to verify that funds are available. It's also a case of, when you have somebody that wants to buy a house for cash, they have to present a bank statement or a letter from a bank that shows they have funds so they can move forward and buy the house for cash. But here's the caveat. When you provide your statement to the bank, make sure that that statement is the most up-to-date statement that you have. And try to avoid changing anything in that statement. Because if you change something, you're going to have to explain it. What I mean by that is, let's say you present your bank statement and it's a full month bank statement. And it shows that you have the money in your account that will cover your potential closing costs and your down payment needs. As you're going through the process, if the process takes longer than 30 days, and unfortunately nowadays it does, the bank's going to ask for an updated statement. So you've sent them a statement that was 1 month statement, and now they're asking for a more updated statement, and you send that in. But during the time of the first statement going in and this next statement going in, there's been activity in the account. Maybe you've had a couple of paychecks deposited because you're on automatic deposit. Maybe you've paid a few bills. Maybe you've made a deposit of monies yourself, all putting into your account. So automatic deposits, those are pretty much explainable, especially if it's a paycheck, because you're going to provide your paycheck stubs or your W-2s or whatever, and they're going to see that's what that money is. But what I specifically want to talk about is deposit money. Let's say, and this is a story that I can relate to, in preparation to buy the home, the buyer had a garage sale. They did a tag sale. They set up tables at the local church for the flea market to sell off a bunch of miscellaneous things that they didn't need. Teacups, plates, clothing, used furniture, lamps, tools, whatever. Now, a lot of us do garage sales and do tag sales. It's not a business. It's just selling some household things to generate a little bit of cash. You've seen them all the time. Now, let's say you have a very successful garage sale. In this particular case, this buyer had a very good one. Over the course of 2 weekends, they generated about $2,000. Fantastic. So what they did is they took that $2,000 that they earned from their garage sale and they deposited it in their bank account. Doesn't seem like it's a difficult thing or a hard thing, right? They got the money and they put it in their account. When the bank asked for the new statement, they saw there was a $2,000 deposit. So the underwriters asked, where did that $2,000 come from? Because you see, they have to verify everything. So the buyer basically said, we had a garage sale and we generated a few dollars on selling some miscellaneous items, and we put that money in our account to make sure we had enough money to cover potential closing costs and down payment. So the underwriter says, well, that's great, but we have to source, we have to prove where that money came from. And saying that you got it from a garage sale by selling a number of items is not acceptable. You have to prove that those monies came from sales and provide a bill of sale showing that amount of monies or a cumulative amount of monies. Well, we all know that when you do a garage sale or a tag sale or a flea market or you sell at a craft or whatever it might be, meaning we don't do bill of sales. If somebody buys an old teacup from me for 15 cents, I don't sit them down and write a bill of sale for 15 cents and have them sign it. It's just not reality. Unfortunately, the requirements of the underwriting system when you're doing a mortgage is they have to verify every single dollar that goes into an account or comes out of an account. Where did that money come from? So the workaround in this particular case is the mortgage company said, okay, we're not going to consider those monies. Now, that was fine because this particular buyer had enough money already in their account to verify the down payment and closing cost needs. This was just extra money that they were putting in their account. So the bank discounted the money. They didn't want to count that money. And this buyer ended up being okay. But what if you have a situation where you're not okay? What if you need, say, $15,000 for down payment and closing costs, and you have $13,000 in your account? You sell some stuff off and you deposit an additional $2,000 from those proceeds to make your $15,000, but you can't explain the $2,000 because you don't have the bill of sale and the bank doesn't want to use that money. Now you're short for your closing. How do you solve that? What do you do? Well, there's a couple of different things you might be able to do, and those are discussions that you can have with your mortgage officer. The point I'm trying to make is simply when you're going through the mortgage process, be very careful on how you handle your money. Let's take a look at this little presentation, and I'm going to be back with another story of another way a buyer kind of made things a little bit more difficult when it came to the mortgage process. I'm talking here on the Real Estate Show about mortgages and obtaining a mortgage and the underwriting process, and sometimes some of the things that can go wrong as you're going through the process. One of the things is realtors, and the mortgage officers also do this, tell a potential buyer, is while you're going through the process of obtaining a mortgage, don't spend any money. At least don't spend any money that you're using, for instance, credit cards for. Don't obtain any loans. Don't make any huge, purchases, things along those lines. Because one of the things that comes into play when you're getting a mortgage is the debt to your income ratio. There's percentages that they have to deal with in order to get the loan through underwriting. So you don't want to make any big purchases. I know it's exciting when you want to buy a house, you want to start buying paint and carpet and maybe furniture, or maybe you're going to update the kitchen right away, so you start putting deposits down on refrigerators and stoves and you get all excited, but you haven't gotten the mortgage yet. So you want to kind of hold off, wait until you get that mortgage approved and you've closed on the property. Because if you do purchase something on a credit card or on a loan basis, that's going to report on your credit report. It's going to be taken into consideration, and it could affect the balance of income to debt that the bank is using to qualify you for that mortgage. So let me tell you a little story. A few years ago, I was working with a buyer, and this particular buyer wanted to invest in multifamily homes. So what he decided to do is we went out after he got his pre-qualification and we found a 3-family home that he put an offer in and it was accepted. One of the things about multifamilies is the bank will use the income from the rentals as part of your total income. They look at a projected income amount when they're doing their debt to income ratios. And there's percentages they use, and again, I am not a mortgage officer. I don't underwrite mortgages. Zone Realty is not a mortgage company. We are a real estate firm. Those are all things that you need to talk to your mortgage originator about. But in this particular case, he got the approved and he got the house. So he's going through the mortgage process. At the same time, he finds another 3-family house and he decides to make an offer on that one too. And that one gets accepted. So now we have 2 houses in play here, 2 multifamily houses. All the houses are rented. There's rental income coming in. His debt to income ratio is fine. Everything looks good. Just before we're getting ready to close, his wife's car has an issue. So he decides she needs a new car. So they go out and they purchase a brand new vehicle. Great for them. Unfortunately, they didn't buy that vehicle for cash. They financed it, creating a loan, creating a monthly payment, creating a debt. So now this shows up on the credit report. The bank sees it when they pull the credit as they're getting ready to finish the processing on the loan, and it changes his debt ratio. In other words, he has more debt now compared to his income. And even with those incomes coming in from those rentals, it's now out of whack and it's just not going to work. And the loan did not happen. He lost those 2 properties that he wanted to buy because he didn't wait to close on the properties first and then go ahead and get his cars later. So again, the moral of that story is don't get anxious. I know things do come along in life. There are unexpected expenses that do pop up, but do the best that you can not to change what you're doing when you're applying for the mortgage. In other words, you pretty much want to freeze everything. You're going to have your statements at your bank with your amounts of money that are in it for your closing and for your down payment amounts. You don't want to touch that bank account. You want to let it stay the same. Automatic deposits are okay if they're paycheck stubs and things along those lines. But you want to not interfere with that account till after you've closed. You do not want to go out and buy anything big that you're going to finance because that's going to affect your debt to income ratio. You want to kind of hold off. It's hard. I know you're excited. You're buying a house. There's things you want to get for the house, but you want to hold off before you make any other kinds of purchases. It's very important that you do not upset the process as you're going through mortgage underwriting. You need to stay very much on the course so that no additional questions or conditions, as they say, will come up for you to have to meet. I want to also talk about tax returns. Now, tax returns are an interesting thing, and a lot of us have basic tax returns and very involved tax returns, depending on what your position is and how you file your taxes. The best tax returns to have are those, of course, that have been submitted and accepted by the IRS. Because even though you're going to take copies of what you filed or get copies from your accountant and present that to the bank's still going to contact the IRS to verify that's what you filed. So in other words, you can't make up stuff on tax forms and send them into the bank and think they're going to accept them. They're going to check that. As I said, the underwriting system that the banks have in place are there not only to protect the bank, but also protect you. So they're going to make sure that everything has checks and balances, everything is verified. And they'll do that right up to the moment you're signing the dotted line at the closing. So again, don't think that you can run out the day of the closing and put that down payment on that brand new couch, because even though you think it might not show up, it may at the last minute, and it could pretty much put the whole deal sideways and you won't get the home. Let's take a quick look at this, and I'll be back with some final comments about mortgages. My final comment is just this. It's a process. It's work. Sometimes it's not easy. Sometimes it's very challenging. It's frustrating. It's aggravating. But it is a process. And like anything, the process has steps that you need to go through in order to get to your goal. So just stay the course. Listen to the advice of your realtor. Listen to the advice of your mortgage officer. And hopefully everything comes together and you get the financing, the mortgage, in place to purchase that home, close on it, and move in. My name is Rick Naples, and this has been The Real Estate Show. I thank you very much for watching. I'll see you next time.